Good morning, everyone, and thank you for joining LaSalle Street's third quarter CIO Perspective Series. Our goal today is to share our current views on markets, the broader economy, and to ensure that everyone leaves this conversation with some clear and actionable insights. That way they can apply to their own investment strategy and their overall wealth planning. As always, we leave roughly 10 to 15 minutes towards the end of the conversation for Q&A. There's a Q&A button on your screen, so feel free to enter those as we progress throughout the entirety of the webinar. For those of you I haven't had the pleasure of meeting yet, my name is Mike Droz, and I'm the CIO of LaSalle Street. And I have the privilege of leading approximately 325 advisors as we navigate evolving market conditions and macroeconomic trends. I'm also the senior portfolio manager for our flagship multi-asset investment strategy, which many of you on this call today are either invested in or actively considering. So thank you once again for joining. We look forward to an engaging and thoughtful discussion. Just a public service announcement. I am slightly under the weather, so if you see me taking a couple of drinks more than often, it's sipping on some tea. I have a little bit of a tickle in the throat, but those of you who have 3 little ones will know how that goes. So we'll go ahead and jump right in. So these are the 10 market themes for the third quarter and what we believe to be the second half of 2026. I won't do a deep dive in all of these, but there's probably 4 or 5 salient points on here that I think we should address today and warrant visiting. So these are all, market-moving topics that, of course, occurred in the past and are shaping and evolving how, the second half of this year will ultimately unfold in the coming months. So first and foremost, we thought it would make sense to recap what actually transpired over the course of, the second quarter. And then, of course, where does that lead us to the second half here? So the S&P 500 traded lower in the first quarter, obviously, and in the second quarter, staging a sharp recovery during the second quarter as well, gaining approximately 14% to finish near all-time highs. So the quarter's arc was one of steady improvement. Of course, we saw the oil shock in the first quarter and the Middle East conflict unfold. And that really pressured equities during Q1 and gradually gave way to easing geopolitical tensions during the second quarter. What we saw was, strong corporate earnings to support those equity prices, and of course, renewed enthusiasm around artificial intelligence. The turning point was when the market was still working through or digesting most of the Q1 sell-off. And in hindsight, early April marked the low point for the entire quarter. Oil prices, which had spiked nearly $115 a barrel amid the geopolitical tensions in the Strait of Hormuz, fell back below $90 during mid-April. And of course, as the US and Iran reached a ceasefire agreement, that diplomatic development combined with falling oil prices, strong corporate earnings, and a strong rally in semiconductor stocks launched a recovery that gathered momentum throughout the rest of the month. And of course, the Federal Reserve maintained their holding pattern. They held interest rates steady through late April, and that meeting produced mostly the most policy dissent that we've seen in recent history, at least over the last 30 years. In May, we saw the recovery continue. May brought additional market volatility, but it did decline alongside further de-escalation in the Middle East and, of course, continued earnings strength. Kevin Warsh was confirmed as the Federal Reserve Chairman, and for the month, the index gained roughly 5%, extending a 9-week win streak total during the month of May. For June, the S&P 500 set a fresh all-time high on June 2nd, but volatility picked up in the final weeks of the quarter as we started to see the impacts of the closing of the Strait of Hormuz. The consumer price index, CPI, rose to 4.2% year over year. That's the largest spike in the past 3 years, and that's, again, largely predicated on the price of oil increasing. So in response to that hotter inflation print, the Federal Reserve held rates steady again on June 17th. And this move, they basically signaled that they're going to stay in a data-dependent mode, or in our most recent findings with Fed Warsh's questioning on the Senate Economic Committee is that most of the heavy lifting he would like to have the bond market do the tightening. Of course, questions around the pace and scale of AI infrastructure are beginning to emerge. Spending weighed on semiconductor stocks, which have become in our view, a crowded trade this year, contributing to some weakness in the back half of June. And despite this volatility, investor risk appetite still remained intact, which really was a large catalyst for that risk appetite was the IPO of SpaceX, reaching a historical cash raise of $85 billion. So the S&P 500 finished roughly up 14%, its strongest quarter since the second quarter of 2020, during the earliest stages of the pandemic recovery. And the remainder of this discussion, we'll take a closer look at the quarter's defining themes, mainly semiconductor stocks, if there's staying power in some of these returns, the AI infrastructure investment, some of the macro themes that we're reviewing, and of course, the evolving stance from the Federal Reserve. So I think we all know we can't dismiss the headlines around artificial intelligence and the circularity around the spending and reinvestment in some of these names. What this chart shows essentially is the quarterly price return of semiconductor stocks going back to 1996, or nearly 3 decades of history in one single view. So semiconductors, as we all know, are advanced computer chips at the center of modern computing and increasingly the artificial intelligence build-out. Each of these bars that you see on the chart today represent the price change over a single 3-month period. The bars on the far right are representing the second quarter of 2026, which stands well above nearly everything that came before. So essentially what this is saying is over the last quarter, semiconductors alone rallied, from a price perspective, nearly 90%. That's, incredibly robust from a performance perspective. So to put that in context, that's the strongest return on record, as you can see. Closest comparisons are, in the late 90s, first, the 68% gain in 1990, and then, of course, 2000, a 65% gain. So, what's driving all this? I think the rally, or when we unpack the returns, the rally was driven, of course, by artificial spending from start to finish, as the largest technology companies committed hundreds of billions of dollars to new data centers, advanced chips, and just development of the technology overall. That spending has flowed directly into semiconductor company results, which we are seeing currently as the Q2 earnings season unfolds, with record earnings and growing order backlogs as well. So a move of this magnitude is notable from any historical measure. The market continues to treat the AI build out as a transformative technological shift. And this quarter's combination of capital spending and earnings growth has largely reinforced that narrative, with companies signaling even greater investment ahead. But at the same time, results like these highlight just how much future growth has already priced into valuations. So for the current pace of investment to be justified, spending will ultimately need to translate into durable profits and attractive returns on invested capital. At the end of the day, that's all investors really are concerned with. The question is becoming increasingly important as the growing share of AI-related expenditures being financed through a new debt and equity issuance rather than internally generated cash flow. So the closest parallel still remains, for this theme, it still remains the build-out of technology in the late 1990s, a period that really demonstrated both the enormous opportunity and the elevated expectations that often accompany transformative innovation. And while the long-term potential of AI remains significant, investors are beginning to look for clear evidence that the scale of current spending can produce sustainable economic returns. Some early signs of caution are also beginning to emerge. If we flip to the other side of the balance sheet, bond market behavior, particularly the direction of long-term yields, suggest investors are becoming more discerning about the durability and profitability of AI-related investments. Earnings growth has remained strong, but the market increasingly appears focused on whether spending can actually generate a compelling return on invested capital rather than simply supporting revenue growth or top-line growth. That caution may also be more influenced by some additional macroeconomic uncertainty and, of course, increased geopolitical tensions, including escalating military activity around not only the Strait of Hormuz, but now the Red Sea, having increased attention on two of the world's most important choke points when it comes to energy and fertilizer shipments. So any additional disruption to these routes could place additional pressure on inflation expectations, economic growth, and making the market less willing to extend the benefit of the doubt to long duration investment themes like artificial intelligence, regardless of the promise. So let's do a little bit of a deeper dive and really understand, what's going on from a CapEx perspective, because this is where most investors are really trying to discern if this is a viable opportunity in the near term. So this slide really answers the previous slide's question is, why did semiconductors rise nearly 90% in one quarter, right? Well, the answer is the enormous amount of capital spend that is being allocated to artificial intelligence. A large share of that flows directly to the companies that make the computer chips. The two charts here really show that there's an investment from two different angles. How fast business spending on the technology is growing relative to history, and who's doing the heaviest spending, the chart on the right. So the chart on the left graphs the year-over-year growth in business investment and information processing equipment and software, and spending companies directly towards computers and networking equipment. So in the first quarter of 2026, this spend grew nearly at a 20% clip compared to the same quarter a year earlier. So a faster pace than even the late 1990s, when the arrival of the internet or the dot-com bubble drove a comparable surge in technological investment. The chart on the right really goes into the weeds and adds the company level detail. So it graphs the combined annual capital expenditures of the 5 leading technology companies building AI infrastructure. We see them on here, it's Microsoft, Alphabet, Amazon, Meta, Oracle. In 2020, I'm sorry, in 2016, these five companies invested approximately 32 billion combined. By 2025, that figure had grown to roughly 416 billion, which is about 12 to 13 times as much. This year, the combined spending is projected at approximately, three quarters of a trillion dollars. So, with forecasts even pointing plus over $1 trillion next year. So this spending, of course, funds the data centers, it funds the chips, the infrastructure, the network equipment, connecting it all, and of course, the cooling required to keep it running. So these two charts are really the engine behind the semiconductor rally discussed on the prior slides, where hundreds of billions of dollars are flowing into the infrastructure. The spending is also supported by data center builders, equipment suppliers, and really, if you think about the picks and shovels that go into building out the infrastructure. So if we look at individual company commentary, it suggests that investment does reflect the real current demand rather than speculative positioning, which is of course positive. Several firms are even indicating they're more constrained by their ability to build capacity than what current customers are demanding. So, from a backlog perspective, that is a positive. The question worth watching from here is how long can the pace of this spending continue, since investment at the scale will eventually need to be justified by a return on that capital. So the one question I get a lot when speaking to clients and speaking to advisors is, is AI a bubble? And the honest answer is probably not yet. But the ingredients are present today. And those are real technology, real transformation, heavy capital spending, and market leadership concentrated in a small number of stocks. That combination closely resembles how the late 1990s looked before conditions became disorderly. And the important caveat is that in 1998, there was a meaningful pullback in the technology names that ultimately became a buying opportunity. And despite that pullback in the third quarter in those technology names, the S&P 500 ended up finishing even higher on the year. Our current view is that the long-term momentum is a theme and it still remains intact. However, in the short term, investors are starting to recognize and beginning to demand tangible evidence on the return on invested capital. So in the near term, given how much this rally depends on a small number of companies and a single spending theme, we are being a little bit more deliberate about how we're managing downside risk in the theme, but do believe that the long-term potential of the technology is still intact. Something that we're watching in the near term, as we highlighted in our 2026 outlook, is the growing role of direct government capital allocation into industries considered strategically necessary, which includes names on this chart that you see here, and of course, semiconductors and artificial intelligence. So again, recent examples include federal equity-linked involvement in companies such as OpenAI and Intel, alongside the introduction of Trump accounts and a sovereign wealth fund structure that there's ongoing conversation about to invest directly in strategic industries. So collectively, these developments function as a form of implicit government backing, which is a meaningful shift in the relationship between federal policy and specific companies, and it is a dynamic worth monitoring as part of a broader positioning discussion. And as previously mentioned, these crowded positions and these names increased bond yields, especially over the last few weeks, higher oil prices may upend most of this in the short term. There's risk there. But again, in the long term, this could also present a buying opportunity, which of course appears to be a structurally longer thematic trend in the technology. Okay. Despite artificial intelligence performing incredibly well over the quarter, I think it's important to recognize that diversification for this year actually has done its job, and specifically diversification within equities. So beneath the headline rally in tech, of course, the second quarter gains were actually pretty positive across, size, style, and factors and geographies. What we see on this slide is just a comparison of total returns to date, which includes, price gains and dividends across 5 market segments. The picture is incredibly encouraging, and for, professional allocators, it's really speaks to what we preach to clients and how we advise other allocators. And that's, not only owning the theme of artificial intelligence, but diversification within equities itself. So you can see that strength has extended itself well beyond not only the S&P 500, but well beyond, those artificial intelligence names as well. Just going down the line, you can see the S&P 500 as of June 30th is up 10%. Small caps have done incredibly well. Russell 2000, and then international stocks, which we highlighted in our 2026 outlook, have outpaced U.S. large cap stocks as well. So the performance gap that you see, and if you just take out the S&P 500 x the tech sector, it is a welcome sign, because it means the market gains are broadening. So you're seeing broadening, and that tends to bode well from where we are in the current economic cycle. Smaller companies, have recently underperformed as inflation rose and the Federal Reserve had to respond by increasing rates just at the index level. And international stocks carried little to none of the none of the artificial intelligence trade itself, which have dominated returns, of course. So this year's participation and outperformance from those segments, of course, is positive, and it's a development worth noting, and an indicator that market breadth is actually improving outside some of that concentration risk that we described earlier. And as I mentioned, it's a reminder of why portfolios are constructed across size, style, and factors. Holding a mix of these exposures means that investors really don't have to depend on one single factor in their equity exposure, which can help smooth results over time. And in a year when the headline has leaned heavily on technology, we can see, based on the returns on the slide, diversification, especially outside those names, it's been doing its job quite well. Just want to touch briefly on the story behind small caps and why they've done so well. We all know small cap profit margins move in cycles. There's a cyclicality to it. So margins historically decline during periods of economic stress, such as the global financial crisis, when they turn negative. And then they stabilized through 2010 and then weakened again during the pandemic as the global economy shut down, of course, rebounding in 2022. With financial conditions really improving over the last year or so, and the Federal Reserve cutting rates not only last year but in 2024, what you're seeing is that finally unfold and some of the margin expansion in small caps. So when inflation rose to a 4-decade high, forcing the Federal Reserve to raise rates sharply in 2022, of course, this impact and compressed some of the pricing price power on some of the small cap names, of course, margins, and small cap companies were hit harder than larger ones. So of course, the story is margins have recovered since late 2024 and currently sit at roughly 4%. The same forces that squeeze smaller companies are now easing, and inflation is coming down from its highs. And the interest rate burden that defined 2022 and 2023 has now faded as the Fed has cut rates to a more palatable range or so. So the broadening naturally raises a follow-up question: is this a durable trend, or is this simply one quarter rotation? And to answer that, it helps to look underneath the hood and what has actually changed for the smaller companies starting with their profitability, as we just described. I'll touch on some of the macro here as we keep things moving. The quarter was a story of two halves, of course. The slide really brings together two of the most important economic stories this year, oil and inflation, because they're really one story. So the chart on the left tracks the price of oil over the past 6 months in 2026, and the chart on the right tracks the year-over-year rate of inflation. The connection between them is simply direct. When oil prices surged earlier this year, they pushed inflation up higher, up to a 3-year high. Now, oil has since fallen back from its peak, but the conflict driving that volatility has not been fully resolved, and of course has a direct implication on the inflation outlook ahead. So if we look at the chart on the left, it's simply the price of WTI crude oil, which is a common benchmark for U.S. oil prices. What we can see is that oil started the year in the upper 50s to $60 a barrel, but that picture changed abruptly in late February, and the conflict in the Middle East and the resulting closure of the Strait of Hormuz, a critical shipping route through which a large share of the world's oil flows, roughly 20 to 25%, created a major supply disruption. So we saw the energy spike. Oil peaked near $115 a barrel in April, and that month really followed some extreme volatility, not only in oil prices, but in equity and bonds. So oil, of course, did fall back from its peak as tension eased and the strait began to reopen later in the quarter. But that decline should not be read as a resolution. As we know, just over the weekend, and there are ongoing talks between Iran, Oman, and the United States, we see that the conflict has now widened outside of the Strait of Hormuz, and disruptions now extend themselves to the Red Sea, not only creating additional pressures from an oil perspective, but blocking out an additional critical point just south of Saudi Arabia. So it's something that we continue to monitor, and remains a real possibility of re-escalation throughout the second half of this year. What looked like a clear path to pre-conflict oil prices early in the quarter looks like there's a less probability that actually transpire. Of course, we'll see what happens over the coming weeks and months as all these three sovereignties try to arrive at some mutual agreement on reopening the strait. So when we put these two charts together, it no longer tells as clean of a story as it did earlier on in the quarter. So we know inflation's rise was driven by oil, and a durable decline in oil would still be the most direct path to easing inflation from here. But the recent widening of conflict introduces real uncertainty to the paths ahead, and that outlook depends heavily on the situation in the region and how it develops over the coming weeks and months. This bears directly on the Federal Reserve's mandate. The oil-driven jump has of course, increased inflation, which was already a major concern from an economic perspective, and has shifted the Fed from considering rate cuts to now weighing in, possible rate hikes or renewed energy disruption pressures prices of oil and bond yields as well. So the key question is no longer simply whether the spring inflation spike rolls back, but whether the underlying conflict allows it to. Okay, I'll touch briefly on the labor market. Um, what I want to take home is that on the labor side, this slide really focuses on the Federal Reserve's dual mandate, labor and inflation, right? They're charged with keeping stable prices and along with promoting full employment, and sometimes those mandates can go head to head or somewhat conflict. And we look at non-farm payrolls for the quarter. The chart on the left is really the change in non-farm payrolls and the number of jobs the U.S. economy added or lost each month. So it shows the pace of job growth declining throughout 2025, including several months of job losses, a sign of some labor market softness. And that softness has carried into early 2026 when the economy lost roughly 160,000 jobs in February. The good thing is the trend has since reversed from a monthly job growth perspective to averaging roughly 180 to 190,000 jobs over the past 3 months from March to May. The chart on the right tells a similar story. Unemployment drifted higher towards the back half of 2025, reaching a peak of 4.5%, and of course has drifted lower down to 4.3%. So when we take these two charts together, they indicate that the labor market conditions have improved this year, with more jobs being created and employment drifting lower. And this improvement is a positive sign for the broader economy, since healthy job market supports spending and reflects the underlying economic strength. It connects directly to the Federal Reserve's dual mandate, of course. Going into this year, the Fed intended to, or at least the market was pricing in that at least one to two cuts would transpire. But given where we are from an inflation perspective, it would see that point is firming, and the case for near-term rate cuts has somewhat weakened. And at least what we have been communicated from Fed Chair Warsh, I guess we'll find out tomorrow and on Thursday, that he'd prefer the market to do most of the tightening and the heavy lifting at this point. As I mentioned, I won't go into details on this. Rate cuts have flipped from rate cut expectations have flipped this year from rate cuts to a possible rate hike. And if you just look at the spread between the 2-year Treasury and SOFR, that's tracking roughly 50 to 60 basis points, which would imply there's at least 1 to 2 rate hikes priced into markets. Our view is that Fed Chair Warsh is likely going to allow the market to do most of the tightening as he continues to formulate these working groups that have and focus groups at the Fed. And as we receive less communication from the Fed, you'll likely see more volatility, not only in the equity market, but bond market as well. Less forward guidance typically means that you'll have a wider dispersion of outcomes because you don't have someone speaking every month or every other month during the Fed meeting, jawboning the market down or jawboning yields up or the other way. What I really want to touch on and close out the call with is where we are and where we think we're heading for the back half of this year. So before we close out, it's worth touching on some developments from the past few weeks. And despite the positive performance for the second quarter, we want to include some forward-looking ideas in how we think markets may evolve given given the 6 indicators that we use for our composite signal that you see on this page. So number one, government bond yields have actually risen to their highest level right before the 2008 financial crisis, and major bond indices are on pace for one of their steepest monthly decline in years. If we look at the Bloomberg Global Aggregate Bond Index, the average yield on that index is roughly at 3.7%, although it has come back a bit. And again, that's coincident with the highest yields that we've seen in 2008. I do think that the market structure is definitely way different than 2008. We have many of the tools that were not available before to address any sort of illiquidity issue in bond markets. But in plain terms, bond prices have fallen sharply and yields have climbed. And this matters for a couple of reasons, of course. Higher long-term yields tend to push up borrowing costs for companies and governments alike. And the continued rise in yields could pressure stocks just as well as investors sometimes shift money out of equities just during the time as investors shift money out of equities to see the compelling yield opportunities as they become more attractive on their own. If you look at the S&P 500 dividend yield, I think we're at roughly 2%, and the 10-year Treasury, is ranges within the 4.5%. 4.6%, right? Both of those carry their own risk. There's duration risk in 10-year treasuries, and especially if bonds continue to march higher. But, if you're just simply looking at from a pure yield perspective, bonds look like a pretty compelling investment today. So it's worth watching closely, and one that could deepen if, the geopolitical tensions and, input costs not only to energy and oil move higher, and of course, bump up inflation, and the knock-on effect would be, bonds continue to sell off as yields move higher. So it's natural to look at this alongside the list of covered questions and themes that we discussed today and feel some uncertainty, right? The past quarter's resilience, keep in mind, I think is also something to hang our hat on and somewhat be refreshing, right? It's a market that faced war, an energy shock, rising inflation, and a more hawkish Fed, and still finished sharply higher. So that's genuinely encouraging, right? That resilience is only one quarter, of course, and not guaranteed resilience in the next. And each of these themes ahead do carry real risk alongside opportunity, as I mentioned before. When we look at inflation and rates, the forces that drove down the quarter's volatility are showing signs of reversing, and a confirmed cooling would remove, a significant overhang from an inflation perspective. But inflation data could also prove to be stickier than expected, and the recent rise in global bond yields is a reminder that markets are already nervous about that possibility. On the AI spend and build out earnings and the earnings behind it, we see that they're real. We have confirmation of that. But the concentration risk we discussed today is definitely something that's notable and worth taking, some portfolio action. A rally this dependent on a small number of companies and a single spending theme, in our view, has further room for disappointment than the headline numbers suggest. When we look at breadth and earnings, the quarter's broadening beyond technology is a constructive sign. Again, diversification outside of those concentrated names. But again, we need to see, a continuation of on quarter-to-quarter data to confirm that it's a trend. That's just simply how allocators operate. So what I'll say is, we know that there's risks involved in investing, of course, in both directions. I think there's potentially some opportunities as a result that potentially come out of the next few weeks. A lot of this is predicated on a resolution in the Middle East. The one message, if anything, as we think about advising clients and folks on this call today, is the most reliable tool for uncertainty is having a diversified portfolio. Because as you can see on this page here, as the probability of returns and unexpected outcomes increase, that simply means from a portfolio diversification perspective that you want to own more returns that have different return profiles. In other words, diversification to help set you up for any uncertain breaks within the back half of this year. So thank you for joining us. With that, I will shift over to our question portion. We do have a couple of questions that have come in, so let me see if we can address those right away. Okay, so as everyone knows on the call, we do manage a set of model portfolio suite. They're risk-based models here at LaSalle Street. One question that came in is, how are we positioned in our portfolios? So we operate a multi-asset class portfolio across stocks, bonds, some liquid alternatives, and commodities, and that's largely based on the client's risk profile. So as of our most recent investment committee meeting, we have made some tactical adjustments. It's not a change in our long-term strategy. The shorter-term positioning is more of a tactical risk management tool that we use in our portfolio. So essentially what we've done is, coming into this year, we did have a modest overweight to equities versus the strategic asset allocation. So we essentially believe that the growth story, which ultimately transpired, given the run-up in the artificial intelligence names, we've modestly trimmed our equity overweight and reallocated that to fixed income and cash. We do still carry a modest overweight in equities versus the long-term strategic target. But as an investment committee, we are reassessing the themes, those 6 composite signals that we evaluate on a monthly basis, and noted that on a 6-month time horizon, some of the knock-on effects of potentially slowing growth, increasing inflation, and rising bond yields, and tapering global liquidity could impact equity prices. So we are monitoring that. So it is something that for now we don't think has too much of a risk, but every day gives us an additional signal, gives us additional data that flows into our construction process. So we are, as you can tell, based on some of the words that I'm using today, we are incrementally more cautious. But we are, again, it's a data-driven process. And we think about, of course, investing in long-term periods, full market cycles, and definitely within construct of our portfolio risk budget. We're not calling that growth is turning down or just essentially dialing back. So ways that we have addressed that, tactically, is we own more quality names, more value within U.S. equities. We still maintain a modest overweight to international markets. Emerging markets still continue to do well. We've taken our emerging markets exposure down to strategic benchmark weight because emerging markets are actually rather exposed to the artificial intelligence trade as well. We also have a slightly more conservative bond positioning. We're shorter in duration than benchmark, and that's largely been a pretty good call for the last few years, especially as inflation has not been to the Fed's target of 2%. And the last 2 or 3 weeks with bond yields increasing, that's really impacted bond returns as well. So if we take this all together, we've trimmed our equity overweight, we added value and quality, we've stayed shorter in duration. So it's an incremental reduction in risk exposure, and that's ultimately how we are positioned for the back half of this year. Of course, this doesn't really guarantee future results. It's just our vision of how those macro composite signals unfold and taken into our data-driven process. Okay, let me see if there's any questions and answers here that are coming from the field. Okay, great question. So, question on gold and gold stocks. I think you have to differentiate both the underlying commodity and then the producers as it relates to miners itself. Of course, there's a correlation between the underlying commodity itself and then profitability on those stocks. But keep in mind, if you are owning a mining company that is mining gold itself, they're also very exposed to broad market activity. So the question is, how are you actually using gold miners in a portfolio? It's you're adding additional equity market risk. Of course, we know that gold is a non-yielding commodity, so you do get some yield out of the equity. But the story behind gold is really more so a result of central bank demand, and what I call as a monetary inflation hedge, right? What you've seen over the last 3 or 4 years is central bank reserves slowly, incrementally moving into gold, the commodity itself, with the People's Bank of China leading the way. And now, why is that? Well, the People's Bank of China, remember, in a closed, what I call capital environment, limit investors to a couple different sort of investments. We know that they can't own Bitcoin, so you think of monetary inflation hedges, Bitcoin is probably one of those, right? Although it's not something we advocate for. There are other ways to get that monetary inflation, gold being the other one. But if you look at China, for example, they're really dealing with their own debt deflation problem. And historically, when you deal with your own debt deflation problem, one lever that the People's Bank of China and China at large has to pull is money printing. So, one way that Chinese investors and the Central Bank of China has dealt with that the literal devaluation of their currency is to own components that are perceived to have some component of preservation of capital or stability. One of those mechanisms or one of those tools is gold, and that's really why you've seen gold over the last 2 or 3 years. And if you just look at on a year-over-year basis, it's still being up close to 65, 70%, perform incredibly well. What I will say is, like, on a go-forward basis, I almost look at, because this is how central banks are also looking at the commodity itself. I'm not saying the reserve currency status of the US is going away anytime soon, but the question is there an alternative? And some central banks are deeming gold versus owning US treasuries as an alternative. The trade-off is, when you have a strong US dollar, that's in direct competition with the price of gold as a safe haven asset. And if anything, what has transpired really as a result of the increased oil prices is a larger demand for US dollars, because commodities are still priced in USD. So that simply means that when the price of oil moves up, that means anyone that is not using USD needs to buy more US dollars to trade in those commodities, ultimately putting a floor under the US dollar and re-strengthening it. So the reason why gold has actually sold off over the last few weeks and months is more so a story around the strength of the US dollar. And of course, that has knock-on effects for the underlying equities. So, the question is, for anyone allocating to gold, are you actually using it for a monetary debasement hedge, or are you thinking about adding it for just a pure equity market play as well? But that's a great question. So I don't see any other questions. I appreciate everyone's time today. Really do appreciate it. And we are here for you, and we're here to help you out. So if you do have any questions, you have my contact information. But other than that, thank you for joining, and we'll be sure to keep you apprised of our next quarterly update. Thank you, and have a good day.